Hello and welcome to my new channel, Accounting with Sandra. My name is Sandra and I'm an accountant and lecturer, and I'm hoping to help students and those with a keen interest in accounting and taxation to understand accounting and taxation concepts with videos in 5 minutes and under. In this video, I'm hoping to explain and clarify the concept of an asset. Over the next couple of videos, we will discuss the other main types of accounting account balances, which are liabilities, equity, revenue, and expenses, before bringing them together to discuss the four main types of financial statements. So, let's begin. What is an asset? So while there is no specific accounting standard which defines what is an asset, we can refer to the Statement of Accounting Concepts, number 4, which defines the various elements of financial statements, which we will dissect together over the coming videos. As per SAC 4, assets are defined as the future economic benefits controlled by the entity as a result of past transactions or other past events. So what exactly does this mean? Let's break down this definition into 3 bite-sized portions. Firstly, future economic benefits or service potential. So in other words, are we able to utilize this particular item to provide or to manufacture goods or services within our business? So for example, if an entity holds inventory that they have purchased or manufactured, this is an asset because when they sell that inventory, it generates the future economic benefit of sales income. Secondly, do we have control over these future economic benefits? That is, does the entity, while using this item to pursue their objectives, deny or regulate access of that item to others? The condition of control can generally be satisfied when considering the legal rights to the item, which can be evidenced by considering items such as title deeds. For example, if an entity holds cash in its own bank account, then it controls that cash balance. No third party can access that cash without first requesting it from the business. Likewise, if the entity owns a property, the title of that property will be on the title deed. Lastly, did a past transaction give rise to these controlled future economic benefits? That is, how did the entity obtain this benefit in the first place? While most assets are paid for via cash or credit, assets can also be acquired through other means like discovery, in the context of mining, donations, grants, or barter transactions. Just a few other considerations to quickly bear in mind. Assets also need to be distinguished between current and non-current. In other words, if the future economic benefits expected from the assets are to be received or earned within 12 months, then the asset is a current asset. For example, cash is always a current asset as it can be applied at any time. Accounts receivable and prepayments, assuming these are to be received or recovered within the 12-month period, will also be current. Where the future economic benefits are not expected to be received within the next 12-month period, but are anticipated to be received or recognized over a longer time period, then that asset is considered to be a non-current asset. For example, an entity acquires a factory within which they have acquired and maintained machinery to manufacture their inventory. The factory and the machinery will be considered non-current, as it would be anticipated that these assets will be held for and utilized for a period of greater than 12 months, thereby generating future economic benefits for many years to come. Assets may also be distinguished between whether they are tangible or an intangible asset. The easiest way to make this distinction is to consider whether you can physically see, touch, or feel the asset. If so, it's a tangible asset. Tangible assets include motor vehicles, inventory if physical items are sold, and plant and equipment. Intangible assets, on the other hand, do not have a physical form, however they still provide the entity with future economic benefits. For example, patents, trademarks, and goodwill. And lastly, for an asset to be recognized within an entity's accounts, it must be probable that the future economic benefits embodied in the asset will eventuate and the asset possesses a cost or other value which can be measured reliably. The term probable means that the chance of the future economic benefit arising is more likely rather than less likely. And in terms of the valuation of the asset, these are generally discussed within the relevant accounting standard, which we will discuss over the next coming videos. Thank you very much for your time, and I hope to see you next time. Bye.